As you know, the double entry accounting is an accounting system under which every transaction is recorded in two or more accounts with equal debits and credits. This is what we have learned earlier. So now I want to emphasize on this definition and then apply double entry principles to various transactions. So that means today you are going to apply double entry accounting principles. So I don't have to explain it again. So earlier I explained the meaning of double entry system. And here, these are the steps to be followed in making an entry in the accounts using double entry accounting principles. First, we need to identify the items of element of accounting equation. Items of elements. Items of element means the accounts, the ledger accounts affected. They identify the items of element of accounting equation affected to various transactions. Then the second step is they identify the elements of accounting equation that the accounting relate, meaning elements means assets, liabilities, owner's equity, revenue and expenses. So in our last class we did this. We identified the items of accounting equation and whether it is increase or decrease. Yes, we have done. So this is a systematic way of doing it. I documented it. Identify the nature of change. Increase or decrease. We have already done it. Then identify the action to be taken. Action to be taken means debit or credit. Increases of assets, we said debit. Increases of liabilities, credit, we said. Increase of owner's equity, credit. Increase of revenue, credit. Increase of expenses, debit. And vice versa. So these are the things that we have learned earlier. So we'll try to understand these steps by working a question. Before that, we want to analyze all the transactions the way we have done in the last class, but adding few additional features or columns. Then we call it transaction analysis chart, where we are trying to analyze each and every transaction. And it is a chart, therefore we call it transaction analysis chart. The transaction analysis chart incorporates the above steps, the steps that I have explained. It is a worksheet used to analyze transactions before making an entry in the ledger. Therefore, it provides guidance. It is a guide to the bookkeeper to make accurate entries in the ledger. So if you analyze the transaction first and then enter into the ledger accounts, then all the entries are accurate. And also it clearly indicates the accounts to be debited and accounts to be credited. So therefore, it is easy, rather than thinking again and again, just to record in the debit side or credit side. So accounting transaction analysis chart. We will use this example. Now we will work out transaction analysis chart. So this is the format for transaction analysis chart. Date, transaction, item or account, element of accounting equation, change means increase or decrease, then action to be taken, action means debit or credit, then amount involved. A date column is to record date and transaction column is to record transaction. So I have already recorded these things for you to save time, and now we will complete the balance part of the transaction analysis chart. Introduction of capital 10,000 kina. This means, as you have already learned, when owner introduces capital, the accounts involved are cash at bank account and capital account. So therefore, first cash at bank and then capital account. Capital, David Kawas. And the element of accounting equation, that is the corresponding asset or liability or owner's equity. So here cash means an asset, cash asset, and then capital means owner's equity. Owner's equity. So here the two categories involved are asset and owner's equity. This means when owner introduces capital, cash at bank, the two accounts involved are cash at bank and capital. The cash is an asset and capital is the owner's equity. Elements of accounting equation means assets, liabilities, owner's equity, and also liabilities. Change. When owner introduces capital, the cash or the cash asset will increase. Therefore, we will put plus mark here, and owner's equity also increases. So therefore, both increase. Asset increased, owner's equity increased. Increase of asset, the action is debit, and increase of capital, the action is credit. So here we can see cash at bank is an asset, and the asset increase meaning debit. Capital increase, therefore capital account credit. The amount involved is 10,000 kina. 10,000 kina for both. So this is the entry in the transaction analysis chart to record introduction of capital by the owner. Cash increased and it by 10,000, and it should be debited because it is an asset. Increase of assets are debited, and capital account is credited by 10,000. Why? The increase of owner's equity also increased. increase of owner's equity is credited. Bought office furniture for the business, the amount involved is 800. This is payment of cash, and bought office furniture. So therefore, the account involved, or rather accounts involved, are office furniture and cash at bank. Office furniture is an asset, so therefore write asset here, and cash at bank also an asset, therefore write asset here as well. So now look at the changes. When you purchase office furniture, the office furniture account will increase, so therefore plus here. And once you purchase asset, you make payment, so that means cash at bank is reduced by this amount. Decreases are recorded here. One asset increased and another asset decreased. The decreased asset is the cash at bank. And when an asset is increased, as you know, it is debited to the asset account, and when an asset is decreased, it is credited. So here office furniture is debited and cash at bank is credited. The amount involved is 800 kina. So 800 kina is written in this column. Next is purchase of cash register. Cash register is an asset, so therefore the account involved is cash register. So we have to have separate accounts for each and every type of assets, and it is not a cash payment, it is a credit purchase. When goods or equipment or whatever you purchase from the creditors or on credit, so then it is, the liability is creditor. We always write the name of the creditor. Here it is Paradise Limited. So we purchase a cash register from Paradise Limited, therefore cash register, the accounts involved are cash register and creditor. Creditor means a liability. When you purchase an item on credit from some other person, a supplier, the supplier is recognized as the creditor. Cash register is an asset, so write here asset, and then creditor is a liability, as you have learned, liability. So then accounts involved are asset and liability. Cash register, once you purchase assets, it is debited, it is the value of that account will increase, so therefore plus, and creditor also in this case increase, because when you purchase a cash register, so the amount payable to him will increase. Now we have increases both increase in this case. Now look at the action. Action is increase of assets, debit, and increase of liability is credit. Amount involved in this case is again 800 kina, right? 800 here in both places. And the transaction that took place on 4th is little bit complicated, but it is real. The business has purchased a motor vehicle. The cost of the motor vehicle is 2,000, and immediately the owner made a deposit of 1,500, and the balance amount is paid later. So this is real, and these are happening in the business world. Therefore, here you purchase a motor vehicle, so therefore motor vehicle account to be created in the books. So we say motor vehicle, and then we have a creditor because we purchase a motor vehicle from Hagen Motors, but full amount has not been paid. Therefore, the amount due, amount payable is 500 kina. Therefore, creditor Hagen Motors and then another account, that is cash at bank, because we paid cash, therefore cash at bank account. Now this involves 3 accounts. Motor vehicle is an asset, so therefore right here asset, and then cash at bank again asset, and finally the last item creditor, as you know, it is a liability. So we have 3 accounts, 2 asset accounts and 1 liability account. Now we will look at whether which account is increased. Motor vehicle increase, therefore plus here, and cash at bank decrease minus, and creditor, the amount payable increase, the liability increase, therefore another plus. 2 pluses and 1 minus. All right. So then increase of asset, as you know, it is debit, decrease of asset credit, and increase of liability also credit. So 3 entries: debit motor vehicle account, credit cash at bank account, credit creditor. Amount involved, now we will have to look at carefully. The motor vehicle we purchase is 2,000 kina, so then motor vehicle increased by 2,000. Cash at bank we paid only 1,500, therefore decreased by 1,500, and amount payable is 500. So now debit amount 2,000, and there are 2 credit amounts 1,500 and 500, then debit total equals credit total. So as we have already learned, double entry means making entries in the ledger accounts, and one of the conditions is this debit equals credit. So in this case, not only 2 accounts, 3 accounts. And 5th June paid 800 kina owing to Paradise Limited. If you can remember here, on 2nd, the owner purchased furniture, and here on 3rd, owner purchased a cash register. Cash register is on credit and it is a liability, and this amount has been settled here. So therefore, amount payable was 800 and full amount is paid here. So then accounts involved are first creditor, Paradise Limited, and then cash at bank. These are the two accounts involved to record this transaction. Creditor Paradise Limited, it is a liability, and here cash at bank is an asset. So this, now the changes, liability decrease and asset also decrease. In this case, both decreased, so minus sign against liability and minus sign against asset. Decrease of liability is credited, and then cash at bank decrease, here it is debit, decrease of liability debit, decrease of asset credit. And amount paid is 800 kina, in both places 800 kina. Next one is introduction of additional capital, whether it is additional capital or initial capital. This transaction will increase capital and cash. So cash at bank, it is always better to write the debit first and then credit later. Cash at bank first and then capital, it is correct. Cash at bank, asset, capital, owner's equity, these are the two groups or elements of accounting equation. The elements are assets, liabilities, and the owner's equity. Here, when the business receives cash, asset increase by 5,000, right? And owner's equity also increase. Pluses for both. And increase of asset, debit, increase of capital or owner's equity, credit, similar to first transaction, and the amount involved here is 5,000 kina. 5,000 debit, 5,000 credit. And 7th June, what happened? Cash drawings by owner. Owner withdrew 500 kina from the business because this is his business and he need money for various expenses. Therefore, he has to withdraw some money from the business. So it is allowed because this is a sole proprietorship. So it is allowed, and the relevant accounts are, there are two options. One is to debit capital account. The other option is create a drawings account. So that is the normal practice. So therefore, let me use drawings. So drawings account is created in the ledger account to record drawings, the amount withdrawn by the owner. Then cash at bank, cash decreased by this amount, and drawings is an owner's equity account. Owner's equity, and cash at bank, as you know, it is an asset. Owner's equity, as a result of drawings, owner's equity will reduce by this amount. So therefore, owner's equity reduce, meaning minus, and cash at bank also minus. Two minuses. Owner's equity decreased by 500. So therefore, debit, asset decrease by 500. It is credit, and here it is 500 amount. Cleaning service revenue received in cash 500 kinas. This is a cleaning business. The amount received in cash is 500. Therefore, cash at bank is one account, and the other one is revenue. Increases, cash at bank increase. So therefore, the element of accounting equation is an asset. Revenue, it is, we can say here, service revenue. We change it to service revenue. Service revenue, this is a service business. So therefore, the main source of this income is the service revenue. Okay, then asset, then next is revenue. Asset increase, and also revenue also increased by same amount. Two pluses, increase of asset, increase of asset, debit, increase of revenue, credit. In the expanded accounting equation, we discuss following elements: assets, liabilities, owner's equity, revenue, and expenses. So this question involves all the elements that we have discussed. Increase, the amount is 500, both accounts 500. And next one is services provided on credit. This is also real. Some businesses, it is a requirement or part of the business life to provide services on credit. So here this cleaning business has provided services on credit, and the name of the organization is the Guruka restaurant. So therefore here debtor is the credit customer. The accounting term to describe credit customer is the debtor. So in this case the debtor is Guruka restaurant. Guruka restaurant. And also remember, debtor is an asset. It is recorded as an asset. Here the second account to be included is the service revenue. Service revenue. Service revenue account, debtor account. These are the two accounts. Debtor is an asset, revenue whatever. Service revenue is classified as revenue, then increases and decreases. Debtor is an asset, therefore it is increase. Revenue also increased. Asset increases debit, revenue increases credit. Now the last column, amount involved is 200 and 200. On 10th, rent expenses paid in cash. So this is an expense. The accounts involved are rent expense. So each and every expense item we will have to create an account, and it is cash payment, therefore cash at bank. These are the two accounts, okay, according to our early explanations. Expense, rent expense is an expense account. Cash at bank, as you know, it is an asset account. Then increases and decreases. Once you incur expenses, so then expenses will increase, and once you make payment out of your cash, then your cash will decrease. And increases of assets, debit, decreases of assets, credit. So debit and credit, always debit and credit. Amount 100 kina, 100 kina here. On 11th, on this date, again credit transaction. The business has purchased stationery on credit from Kina stationery shop. So here stationery is an expense, so therefore expense account, and creditor. Creditor, write the name, Kina Stationery Shop, stationery shop, and now decide the elements of accounting equation. Expense, we can say here, let's change this stationery expense, stationery expense to make it clear. Then it is expense, and creditor is a liability, here, and keep on entering. C capital. Expense increase whether it is credit or cash. Once you incur expense, so we recognize as expense, therefore expense increase. Expense increases, liability also increases. And increase of expense, debit, increase of liability, credit. And amount involved is 50 kina, therefore both places it is 50 kina. So this is the transaction, completed transaction analysis chart. So as I explained earlier, the transaction analysis chart is very important for us to understand the double entries and the accounts involved. So this is not necessary once you learn these basic principles, but at the initial stage it is better to learn transaction analysis chart and enter all the transactions in the transaction analysis chart and see whether all the entries are made correctly. So then it is easy for you to post these transactions to the ledger accounts. So this is the transaction analysis chart. All the time when you complete the first column, the item or account column, item means the item of accounting equation, another term is the account. So identify the accounts involved and classify these accounts as assets, liabilities, owner's equity, revenue and expense, and write the correct element of accounting equation in this column, and then whether it is increase or decrease we have to indicate here, and then action to be taken. Action means debit or credit. So this increases and decreases will help you to identify debits and credits, and the final column is the amount column. It is basically given in the as part of the transaction. The second part of the question is to prepare ledger accounts. As you have already learnt, there are two forms of ledger accounts. First one is the T format ledger accounts, and the other one is the columnar format ledger accounts. First we will prepare ledger accounts on T format account. So this is T format ledger. These are T format ledger accounts, and first thing we need the title of the account, and then date, particulars, journal reference, and the amount. This is the debit side, and credit side also you can see same columns. To record these transactions, first we will have to look at the transaction analysis chart, because we prepared the transaction analysis chart as a guidance to prepare ledger accounts. So therefore, we need account for cash at bank, write the title here on top in the middle, and remember, we don't write account everywhere. When you write cash at bank, it is understood that it is cash at bank account. When you write say here capital, this means capital account. You don't have to write capital account, cash at bank account, rent account, and so on. This is the tradition. And date, the first transaction, the double entries are cash at bank debit and capital credit. So therefore, cash at bank debit means making an entry in the debit side of the account. First write the date first the year 2007 and month June, write June here, and the date is first. Now date column is completed, and now we will have to make the entry. The amount involved is 10,000 debit, right, and again here 2007 June 1st, and amount involved is 10,000. Now what are we going to write here in the particulars column? Particulars column, we don't write any other details other than the title of the corresponding account. In this case, the corresponding account is capital account. And here in the capital account, corresponding account is the cash at bank account. This amount is taken from the cash at bank account. So therefore, in capital account we write cash at bank, and cash at bank we write capital account. So that is called corresponding accounts. We don't write anything, any other details. Just write the title of the corresponding account. That is the first entry according to the transaction analysis chart. The second is office furniture account debit and cash at bank account credit. So we need another account, new account, office furniture. This is our office furniture account. Office furniture account debit. Then we have to write the date 2007 June 2nd, and the title of the corresponding account is cash at bank. Therefore write cash at bank. The amount is 800 kina, and credit cash at bank account. In the credit side, no date, therefore write the date first. 1 second. Cash at bank credit, and debit entry is in the office furniture account, and record 800 in the amount column. Leave this column, journal reference column, for future lessons. So at this stage I don't want to make it complicate, so leave this one for future lessons. And on third, cash register, a new account, debit, and creditor Paradise Limited credit. So we need two more account, cash register, and creditor Paradise Limited. So double entries are cash register, account debit, and Paradise Limited credit. So again we don't have the date, therefore we will have to write the date, June 3rd, and this amount is credited to creditor Paradise Limited, therefore creditor Paradise Limited, amount 800 again. Paradise Limited credit, date 2007, June 3rd, title of the corresponding account is the cash register, 800 kina. So that is the credit entry. 4th June, look at the transaction analysis chart. The accounts involved are motor vehicle, cash at bank, and creditor Hagen Motors, 3 accounts. So we don't have accounts for motor vehicle, so therefore create one account, motor vehicle account, and creditor Hagen Motors, and cash at bank account. We have a cash at bank account here. Motor vehicle 2007, June, fourth, debit, cash at bank, we paid 1,500, cash at bank, credit 1,500, date 4th here, sorry, go to the cash at bank account, date 4, and motor vehicle. Amount is 1,500. 1,500 paid, therefore cash at bank account credit, and here motor vehicle debit. And also the 500 kina, the balance amount is a liability, so this 500 to be credited to the creditor's account. Creditor Hagen Motors, 500 kina, Hagen Motors 500 kina here, 2007, June 4th, motor vehicle account, motor vehicle account debit, and Hagen Motors credit 500. Now if you want to analyze this transaction, motor vehicle account 2,000 total, and this 2,000 consists of Hagen Motors credit 500 and cash at bank 1,500 credit. So as we have learnt, the double entry accounting is an accounting system under which every transaction is recorded in 2 or more accounts with equal debits and credits. 2 or more. In this illustration, most of the transactions involved 2 accounts, but in this particular transaction involves 3 accounts. So, it is possible, sometimes more than 3, right, more than 3, here 3 only. Now, let us look at the other transaction, but remember the debit equals credit. Here motor vehicle account, debit 1,500 and 500, total 2,000, and credit amounts also 1,500 and 500, here 2,000. Debit total equals credit total. Let us look at the next transaction. 5th June, creditor Paradise Limited debit and cash at bank credit. Creditor Paradise Limited, we have one account here, debit 2007, June 5th, and it is cash at bank credit. Therefore, title of the corresponding account is cash at bank account. Amount is 800. Cash at bank 800. Creditor Paradise Limited 800. $800. Here the interpretation is we purchase a cash register on credit and the amount payable to him, payable to this company is 800, and now we paid 800 kina and there is no balance in this account. Full amount has been settled. Now 6th June, cash at bank debit and capital credit. So, we have cash at bank account here and also capital account. Date 6th, capital 5,000, capital, date, cash at bank, that is the title of the corresponding account, amount is 5,000. Similar to first transaction, and on 6th we have to have 2 accounts, cash at bank and drawings account. Cash at bank we have already here, and we don't have a drawings account. Drawings account here, drawings account, debit 2007, June, put the date, that is 7th, cash at bank credit, drawings debit. Therefore, the title of the corresponding account is cash at bank, amount 500. Now move on to the cash at bank account. Here it is 7th, drawings 500K. Next transaction on 8th, the double entries are cash at bank debit and service revenue credit. So, we don't have a service revenue account. Now, we will open a service revenue account. Service revenue account and cash at bank. So, we have cash at bank account here. Date 8, service revenue cash at bank debit, cash at bank debit, and service revenue credit. Cash at bank here in the particulars column, amount is 500. Ninth, services provided on credit. Therefore, the double entries we have already identified and recorded in the transaction analysis chart. What are the double entries? Debtor Guruka Restaurant. So we don't have account, so therefore create an account. Debtor Guruka Restaurant. Guruka Restaurant, and we have service revenue account here. Then double entries are 2007 June 9th service revenue, service revenue 200 Guruka Restaurant debit, and service revenue credit. Here write the title of the corresponding account. Debtor Guruka Restaurant, amount is 200. Tenth, check the transaction analysis chart. Tenth, rent expense debit and cash at bank credit. So we don't have rent expense account. Therefore, create an account. Rent expense debit 2007 June 10th, and write the corresponding account title, cash at bank, 100 kina, and then move on to the cash at bank account here. Cash at bank, it is rent expense, $100 The last one is purchase of stationery on credit. So we don't have stationery account. Therefore, we need one account for that. And another account for the creditor. Stationery expense. Stationery expense. And this is creditor. The name of the creditor is Kina Stationery Shop, right? And the double entries are stationery expense debit, stationery expense debit, date 11th and stationery expense debit, credit, creditor. Creditor Kina Stationery Shop. Amount is 50 kina debit, and here write the date June 11th, and here what we are supposed to write, stationery expense 50 kina. There is no cash involvement, stationery debit and creditor stationery, Kina stationery shop credit. So these are the double entries. You can see debit and credit. For all the accounts, if you look at carefully, for each debit entry there must be a corresponding credit entry. So that is double entry accounting. Now we can go further step, that is the balancing of ledger accounts. Ledger accounts are normally balanced frequently. So it is, we will assume that this business balances its accounts on 11th of June, and now we will try to understand the balancing procedure. Balancing procedure involves identifying debit total and the credit total. The balancing means find the difference between debit total and the credit total and record it in the appropriate side and bring it down to the other side. So basically the balance means the difference between credit total and the debit total. So now we will work out the cash at bank account and try to balance this account. How to balance this account? When you look at the totals in debit side, it is 15,500 and debit side 15,500, credit side is less than that amount. So therefore, find the total, take the calculator and find the credit side total, 800, 1,500, 800, 500, 100. Then that works out to 11,800. Here it is 15,500. Debit side total is 15,500. Then write the same amount in the credit side also, in the same line, on the same line, 15,500. This side total is 3,700. Total is 3,700. Then 15,500 minus 3,700 is 11,800. So write the balancing date here. Balancing date, as I said earlier, it is 11th. 11th is the last day of these transactions. So we assume that we balance all these ledger accounts on 11th of June. So here you write balance and it is the balance carried down. It is written like this, CD. Balance CD means balance carried down. So then it is equal to 15,500 minus 3,700. The difference between these two is 11,800. So 11,800 is the balance in this case. And draw double line here. Double line, and bring the balance after the total. So here the date is 12th. Then on the 11th we balanced this account and brought this balance down on the following day to start or make cash transactions. So here we write balance BD. BD means balance brought down. Same amount, 11,800. 11,800. So then transactions on 12th will be recorded here after the total. So this amount is brought down. So that is the procedure, balancing procedure. For all the accounts you can follow the same procedure. Here let's look at all the accounts. 15,000 here, there are no entries in the debit side, so therefore write 15,000 in the same line. 15,000 here, and balancing date is 2007 June 11th, as I said earlier, and nothing to deduct, it is the same amount. Balance CD 15,000, 15,000, double line here, double line, then 12th, we balance the accounts on the 12th and brought that balance down on the following day, that is 12th. Balance brought down is 15,000. Office furniture accounts, same, no transactions recorded in the credit side, therefore same procedure. 11th, balance CD 800, total also 800, both sides same amount, double line, double line, and here 12th, balance BD 800, again here cash register, only one transaction, therefore write the date, it is 11th, balancing date, balance CD 800, total also 800, double line, that is the total, to indicate total, draw double lines. So 12th, balance brought down is 800, right? If you look at this account, it is different from the other accounts. 800 debit, 800 credit, that means there is no balance, therefore total it and no balance. Double line to indicate that this is the total. Motor vehicle, here we have two entries. Total is 2000, 2000, here again 2000, therefore the balance is June 11th, Now let's look at the motor vehicle account. In the motor vehicle account, there are two transactions in the debit side, 1500 and 500. The total is 2000. Write 2000 here. And there are no entries in the credit side. Therefore, write the same amount in the credit side as well. Then write the date, balance in date, 2007, 11th June. Then write balance carried down, CD, 2000. Double line here to indicate the total, and in the credit side also, and immediately after entering the balance CD and bring it here, it is 12th, balance brought down, BD, 2000. Hagen Motors, only one entry in the credit side, therefore write the same amount in the debit side as well, 2007, June 11th, that is the balance in date, balance carried down, 500, see the total, double line, and bring the balance here, balance brought down, 500. Now move on to the next account, drawings account. Drawings account, only one entry, 500 here, credit side 500, balance in date 2007, June 11th, balance CD 500, the total, both sides, double line, and balance in date 11th and carried down on 12th, balance BD 500. Next account, only credit entries, 700 total, write 700 here, and 2007, June 11th, balance carried down 700, total 700, total 700, balance in date 11th and 12th brought down, balance BD 700 here. Then this is Goroka restaurant, only one entry, 200, 200, date, then it is 11th, balance carried down 200, double line, and 12th balance brought down 200. Next, rent expense, only one entry, balance carried down 100, total 100, double line for the total, twelfth balance brought down 100, stationery expense, one entry, June 11th, balance carried down, same amount 50, total 50, and here was 50, double line, 12th balance BD 50, Kina stationery shop, only one entry, therefore balance also same amount, June 11th balance CD, then total same amount, double line, 12th balance 12th, it is the opposite side, 12th balance brought down 50. So now we have balanced all the ledger accounts. Firstly, we entered all the double entries in the ledger accounts, and then we balance. So balancing, once you balance it, it is important for you to recognize or identify the balance, whether it is credit or debit. So then how do we identify debit balances and credit balances? This is the rule. If the debit side total is greater than the credit side total, then the balance is recorded in the credit side of the account. The carried down balance is recorded in the credit side of the account. So then this balance is called debit balance. For instance, in this cash at bank account, debit side total is 15,500 and credit side total is 3,700. So the balancing figure is 11,800. This 11,800 belongs to the debit side. So we borrowed this 11,800 to fill this gap. So therefore, this belongs to the debit side. On that basis, we call it a debit balance. So it is easy to remember, if carried down balance is recorded in the credit side, it is a debit balance. Similarly, if there is a carried down balance is recorded in the debit side, so then it is called a credit balance. Now, cash at bank account 11,800, carried down balance is recorded in the credit side, therefore it is a debit balance. Capital account, carried down balance is recorded in the debit side, therefore it is a credit balance. That is one way of identifying the balance. The other method is the opposite of this. If brought down balance is recorded, if the brought down balance is recorded in the debit side, it is a debit balance. So in this case, cash at bank account balance 11,800, brought down balance is 11,800, so therefore it is a debit balance. So this is a debit balance. Capital account brought down balance is recorded in the credit side, so therefore it is a credit balance. Now look at furniture account. Brought down balance is recorded in the debit side, therefore it is a debit balance. Cash register, brought down balance is recorded in the debit side, therefore it is a debit balance. And here, motor vehicle, brought down balance is recorded in the debit side, therefore it is a debit balance. Look at the creditor Hagen Motors, brought down balance is in the credit side, therefore it is a credit balance. So that is the way of identifying the nature of the account, debit or credit. So based on this, the next step is to prepare a trial balance. Trial balance is the list of ledger account balances. Debit balances are shown in one column and credit balances are shown in another column. So let's look at the trial balance. Trial balance, this is the format. This is the format. Just write trial balance. Better to write the complete title. A complete title means the name of the business. In this case, it is David Kawas. That is the first line, to write the name of the business. Then title of the statement, it is trial balance. And third is the time period. So this is as at 11th June 2007. And here the debit balances, credit balances another column, and here account title. When you say account, it is the account title. So we have several accounts, starting from cash at bank account. Write the title of the account. First one is cash at bank account. It is a debit balance 11,800 because brought down balance is recorded in the debit side, if you follow that method. Right. Next one is capital account. Capital account shows a 15,000 credit balance, and office furniture account shows a debit balance of 800, write it in the debit column, and cash register account shows a debit balance, and the motor vehicle account shows 2000 balance, debit balance. Then next one is drawings. Drawings account shows 500 debit balance. Then creditor Hagen Motors shows a credit balance of 500. Then service revenue. Service revenue account shows 700 credit balance. Debtor Goroka Restaurant shows a debit balance of 200 kina, and then a rent expense account shows 100 kina debit balance, and then stationery expense account shows 50 kina debit balance, and the last one, creditor Kina stationery shop it shows 50 kina credit balance. Let the last one. So now we can find the total. Take the calculator and find the total. 15,000, 16,200, 16,250, right? 16,250 credit side, credit column, credit balances, total 16,250, then debit column total. How much is that? It is 16,250, same amount. So this is the outcome of double entry accounting. If you follow the double entry principles, so each debit entry there must be a credit entry, and debit total always equals credit total. Debit equals credit, so therefore debit balances equals credit balances at the end of any period after posting some of the transactions following the double entry principles. So this is the trial balance. So trial balance shows that we have made the double entries correctly, and therefore the trial balance shows debit total equals credit total. Having completed the first part of the question, now we will look at the second part of the question, that is to prepare columnar form ledger accounts. Columnar form ledger accounts, you can see the format here: date, particulars, journal reference, debit column, credit column, and the balance. So here there are no two sides like in the case of T accounts. Here only debit column to record both debit column is to record particulars column is to record both debit and credits. It is common to both debit and credit column, and also the additional feature here is the balance. After each and every transaction you record here in this columnar form ledger accounts, you have to balance or show the balance. Now we will use the same transaction analysis chart. The transaction analysis chart we have done for the first part of the question. Now we will look at the same transaction analysis chart and complete the columnar form ledger account for the business. Now we will start with cash at bank account, cash at bank, and capital account. This is your capital account. Now we will record the first transaction. Write the date, year 2007, June 1st, and particulars column. Same principles are applicable to columnar form ledger accounts as well. So it is introduction of capital, therefore capital account credit and cash at bank account debit. 10,000 here in this column, and after making an entry in one of these columns, so then record the balance also, and this is a debit balance because there is nothing in the credit column, therefore it is debit. And the double entry in capital account 2007 June 1st, particulars, title of the corresponding account, that is cash at bank account, cash at bank account debit and capital account credit 10,000, and after this entry complete the balance column, it is credit. Now look at the second transaction. Bought office furniture 800 kina, so date 2nd, office furniture debit and cash at bank credit, so therefore here office furniture credit 800. Now the balance is debit 10,000 minus 800 means 9,200 debit. Still debit is more. Debit value is greater than the credit amount, therefore the balance is 9,200 here. And then we need office furniture account. Office furniture, write the date June 2nd, cash at bank, office furniture we said it is debit, therefore 800 debit balance. Next transaction according to the transaction analysis chart, cash register debit, so then we have to have a cash register account. Register account, date 2007, June 3rd, cash register, account debit, and creditor, Paradise Limited, cash register, debit, value is 800, debit here. And we need account for Paradise Limited, creditor, Paradise Limited, Paradise Limited credit, write the date first, June 3rd, cash register, credit 800, then 800 is a credit balance. Next, 4th, motor vehicle account debit 2000, cash at bank credit 1500, and creditor Hagen Motors 500. So we don't have a motor vehicle account, then open up a motor vehicle account. Motor vehicle, motor vehicle 2007, June 4th, and cash at bank, similar to the previous entry that we have done. Cash at bank 1500 here, debit, and creditor Hagen Motors 500, and now total is 2000 debit. Now move on to the cash at bank account. Cash at bank account, date 4th, motor vehicle account, debit and cash credit 1500, now 9200 minus 1500 is 7700, still it is a debit balance. So we made the cash at bank account entry and then move on to the Hagen Motors account, creditor Hagen Motors, date 2007, June 4th, motor vehicle account debit and credit Hagen Motors, then 500 credit. Now if you want to look at the double entries, cash at bank credit and motor vehicle debit, Hagen Motors credit and motor vehicle debit. The total debit is 2000, which is equal to 500 credit here in Hagen Motors and 1500 credit in cash at bank account. 5th, paid 800 Kina owing to Paradise Limited. We have double entries are creditors Paradise Limited, debit and cash at bank credit. So here creditor Paradise Limited, amount 800 and minus 800, Therefore, the balance is 6,900 debit. And move on to the credit Paradise Limited. We have Paradise Limited's account here, and date is 5th right here, and then cash at bank. That is the title of the corresponding account. The amount is 800. Credit 800 balance, and now we made an entry in the debit side. So then credit 800 minus debit 800 gives us 0 balance. So therefore here no balance. No balance. So this is possible. Next, 5th, then 6th. Additional capital. The owner introduced additional capital. 6th, capital account, 5,000. Now 6,900. Here debit and 5,000 another debit, therefore addition 11,900 debit. Now move on to the capital account. Date is 6th, cash at bank, credit 5,000. Now total capital account balance is 15,000. 15,000 credit. Next, 7th, owner's drawings. So then we have to open up an account for that. That is drawings account debit, date June 7th, cash at bank, credit and debit drawings account. Amount is 500 kina, balance also 500 debit. And move on to the cash at bank account. Here date 7th, drawings account. It is a payment, therefore credit 500, 11,900 debit, and here we credited 500, therefore minus 11,400 debit balance. 8, cash received revenue, service revenue 8, then cash at bank account debit, cash at bank debit, amount is 500, add 11,900 debit. Sorry, here it is not cash at bank, it is service revenue. Now we have to open up a service revenue account. Service revenue. Write the date first. June 8, cash at bank, title of the corresponding account, service revenue, credit according to the transaction analysis chart, 500, therefore 500 credit balance. 9th, Debtor Goroka Restaurant debit and service revenue credit. It is a credit transaction. Therefore, debtor with Goroka Restaurant 2007 June 9th service revenue account debtor Goroka Restaurant debit 200, balance also debit. Here we have the service revenue account, date 9th, and write the title of the corresponding account. Debtor Goroka Restaurant. Credit 200, credit 500, opening balance, and another 200 is added. Therefore, balance is now credit 700. 10th, paid rent. Double entries are cash at bank debit and rent expense credit. Rent expense debit and cash at bank credit. So we have to have a rent expense account, and date 2007 June 10th, rent expense debit, cash at bank credit. Therefore 100 here, balance also 100. Now move on to the cash at bank account here. It is 10th and rent expense is a cash at bank credit 100. Therefore the balance is 11,800 debit. Next transaction is stationery purchased on credit transaction. Then we have to have a stationery expense account, stationery expense account, and another account for the creditor. This is a credit purchase, so we need another account for creditor. Creditor's name is given, that is Kina Stationery Shop. Stationery account debit, stationery account debit, creditor Kina Stationery Shop, debit 50, balance also 50. Now creditor's account, June 11th, stationery expense, credit 50 and balance also 50. Now we have completed all the ledger accounts. Now you can compare with your T accounts and also the trial balance Even the T account, cash at bank account, shows 11,800. Here it is the columnar form. So you can find the same answer without any effort. So you don't have to follow any additional principle to identify debit balances or credit balances, and no extra effort for you to balance the account. In T accounts you have to make follow the balancing procedure, but here the procedure is simple. After each and every transaction you record in the account, you have to find the balance and record it in the balance column. For all the accounts you can find the balance after each and every transaction. So then if you prepare a trial balance using these balances, again it is the same trial balance. Now you can compare with your trial balance and also the ledger accounts. These amounts are same. So if you want to check the trial balance, 11,800 debit, capital account credit 15,000, furniture account debit, cash register account debit. All these are there in your trial balance, and here no balance. Motor vehicle 2,000 debit, Hagen Motors credit, drawings 500 debit, and here service revenue credit 700, 200 Goruka restaurant debit in your trial balance, rent expense account 100 Kina, stationery expense 50, and Kina stationery shop 50 Kina credit. Okay, this is easy, right? If you know the principles, I think this is the easiest format, but you have to indicate the correct balance. Illustration 4.1. This relates to accounting for trading businesses. So now look at the illustration given to you. We will work out the transaction analysis chart similar to previous examples. Date, transaction, item of accounting equation or account, and element of accounting equation, then increase or decrease, then action means debit or credit, and finally the amount. The first transaction, the owner introduced capital, then the relevant accounts are cash at bank, and capital account, and then cash at bank belongs to assets, therefore right here asset, capital, owner's equity, capital is owner's equity account, decrease or increase or decrease when capital introduced, cash increase by 20,000, and capital also increases, therefore both pluses. Increase of asset debit and increase of owner's equity credit, similar to service organizations. Amount here is 20,000 and 20,000 here. Purchase motor vehicles. The accounts involved are motor vehicle. Better to write the debit entry first and then the credit entry for the account. And this is a cash payment, therefore cash at bank. Motor vehicle is an asset. Cash at bank also an asset. Motor vehicle asset increased. Cash at bank asset decreased. Increase of asset debit, decrease of asset credit. Amount involved 3,000, 3,000. Sorry, this one not. Second one is not cash transaction, it is a credit transaction. Therefore, I will have to change this. Motor vehicle and creditor lay motors. Motor vehicle account, creditor lay motor traders credit. Creditor lay motor traders. Asset, motor vehicle is an asset, and creditor is a liability. Motor vehicle motor vehicle is an asset, creditor is a liability. Now increase or decrease, asset increase, and also liability also increased. Liability increased, asset increased, increase of asset debit, increase of liability credit. Amount 3,000 here, last column. Now on third, cash payment to lay motors. Therefore, creditor, the payment to creditor, lay motor traders. And cash at bank account. Creditor is a liability, and cash at bank is an asset. Liability decreased, liability decreased, asset also decreased, asset also decreased when payment is made. Increase of liability, debit, decrease of asset, credit. Amount paid is 2,500. Next, purchase stocks for cash. Then here, purchases account, trading business. Therefore, all the trading businesses, there must be a purchases account to record all the purchases. Purchases account and cash at bank. Purchases account is an expense account and cash at bank is an asset account. Expense increased, and asset decreased. It is recorded. Expense increased, increase of expense, debit, and decrease of asset, credit. Amount 2,000. Payment of wages, wages account debit, and cash at bank, wages expense. If it is an expense, cash at bank, asset, expense increased, asset decreased, expense increase of expense debit, decrease of cash credit. Amount is 300 kina. Right, it is done. Next, move on to the next line. Sold stocks for cash. So that means cash at bank and sales. When stocks are sold, we have to have a separate account called sales. Cash at bank, an asset, sales, revenue, cash received, therefore increase of asset, and revenue also increased. Increase of asset, debit, increase of revenue, credit. Amount involved here is 3,500, included in the last column. Purchase stocks on credit from Hamamas Limited. So therefore, stocks means purchases, correct, and creditor, purchased on credit, therefore creditor, Hamamas Limited, purchases, expense, creditor, liability, then expense increased, liability also increased. Now debits and credits, increase of expense, debit, increase of liability, credit. Amount 1,500, 1,500. 8. Sold goods on credit. Therefore, here once goods are sold on credit, we have an account called debtors account. Debtor, nego, and sales. Debtor, an asset, sales, revenue. Increase of asset and increase of revenue. Increase of asset, debit, increase of revenue, credit. Amount is 3,000, 3,000 credit. Next, 9th January, introduction of capital. You are familiar with this. Cash at bank and capital account. Cash at bank is an asset. Capital is owner's equity, and increase of asset, increase of owner's equity, increase of asset, debit, and increase of owner's equity, credit, and the capital introduced. Amount involved here is 5,000. 5,000. 5,000 debit and 5,000 credit. Last one, owner withdrew cash, drawings account, the accounts involved are drawings and cash at bank. Drawings, owner's equity account, and cash at bank is an asset account. Drawings decreases, owner's equity, and cash at bank also decreases. Drawings account, debit, cash at bank account, credit. Amount 500, 500. So now we have completed the transaction analysis chart for illustration 4.1. So this is a trading business. And in this business, you have seen different accounts, purchases and sales. Purchases on credit, purchases for cash, sales also for cash and also on credit. So as we have discussed earlier, in trading businesses, the main transactions are purchase of goods and sale of goods, and purchases returns and sales returns. So we have to have separate accounts for those accounts. Now we can prepare ledger accounts using this transaction analysis chart. Now I will prepare T accounts and you can follow how it is done. Take out your completed transaction analysis chart, and by looking at the cash transaction analysis chart, we will make entries in these ledger accounts. Firstly, cash at bank account and capital account, then transaction, write the date as usual, this is January 1st, capital account. So now I am not going to explain each and every transaction, so you know how to make double entries. Be careful, record them in the correct side of the account and also in the correct account, and write or the complete particulars column using the principles I have explained earlier. Cash at bank 20,000, capital account credit, next motor vehicle, and lay motor traders, lay motor traders, so creditor, creditor lay motor traders, double entries are motor vehicle debit, January 2nd, creditor lay motor traders, amount 3,000, (2008), January 2nd, motor vehicle, 3,000. Next, cash at bank. Cash at bank credit 2008 January 3rd. Creditor Lay Motor Traders 2,500 paid, and Lay Motor Traders 2008 here. Cash at bank, amount paid is 2,500. Purchase stocks, so then we have to have another account, that is purchases account. Okay, here purchases debit 2008 January 4th. Cash at bank credit, cash at bank credit 2,000. Purchases debit, it is January 4th. Purchases 2,500. Next, paid wages. Now we need wages account. Wages expense. Wages expense debit 2008 January 5th. Cash at bank amount 300 kina. Then cash at bank account credit cash at bank credit 300. Next, 5th, sold goods, cash at bank account debit, cash at bank account debit and sales account credit. Amount is 3,500. Now we have to open up a new account for sales. Sales credit, sales credit and cash at bank debit. Therefore here cash at bank 3,500. 7th, purchases debit and Hamamas Limited credit. So we don't have an account for Hamamas Limited, so therefore we will open up an account here. Creditor Hamamas Limited, Hamamas Limited, credit 1,500 and debit purchases. We'll make the debit entry first. Date 7th, creditor Hamamas Limited, amount 1,500, Hamamas Limited, credit 2008, January 7th, purchases 1,500. That is on 7th. 8th, credit sales. For credit sales, we need one account for the debtor, debtor nego debit, January 8, sales credit, therefore write sales here, amount 3,000 and find the sales account here, it's here. 8, debtor nego 3,000. 9th, cash at bank debit, cash at bank debit and capital account credit. Amount 5,000, capital account is here, cash at bank, amount 5,000. Next, cash drawings by the owner. Then we have to have another account, drawings, drawings account debit 2008, January 10th, cash at bank and amount is 500. Here we have cash at bank account, credit, credit drawings, amount 500. 5th, this is a mistake, it is not cash at bank, wages expense, wages expense. Now we recorded all the transactions. Now next step is to find the balances or balance the accounts. You know the balancing procedure, T accounts. Take cash at bank account. As you can see, debit side is more, therefore both sides you have to write the highest value, that is 28,500, that is the total debit side total, credit side also you have to write the same amount. And now find the total. Credit side total 5,800. 5,800 minus 28,500 is here 2,500. Item purchases. Let's check purchases account. Purchases account, it is 2,000. Therefore, it is a mistake. We'll correct it. Then the total is 2,500. 2,000 and 800, 5,300. Then the balancing figure is 23,200. So this is the difference between debit total and the credit total. The balancing date is 10th. Therefore, we don't have to write it again. 10th is already there. Balance carried down 23,800. 23,800. And double line here. Decline to indicate the total, and double line as well. So now we have completed, and remember the balance brought down is 23,200. For each and every account, you have to show carried down balance as well as brought down balance. Here it is easy. Only credit entries 25,000. 25,000 both sides, and 2008 January, balancing date 10th, and balance carried down 25,000. Draw lines, both sides. Motor vehicle account, 25,000 here, capital account. Then on the 11th, balance brought down 25,000. So capital account balance is 25,000. Here 2008 January 10th, balance carried down is 3,000. Motor vehicle 3,000. Then the total these are important aspects to show the total correctly. and draw lines correctly. That's why I am taking some time to complete these accounts perfectly. Balance brought down here 3,000. Then move on to the other account. Lay Motors, creditor Lay Motor Traders, credit side 3,000, debit side 2,500, therefore credit side is more, credit side is more, so therefore write the total, both sides same amount. Same amount, double lines for the total, and balance on this date carried down is 500. This means we bought a motor vehicle for 3,000 on credit, and later on we paid only 2,500. Still 500 payable, 500 outstanding. So 11th balance brought down is 500. Next, purchases. Purchases, credit side, no entries, no entries. Therefore, total of the account is 3,500 to be written in the credit side as well. Then total (2008) January 10th, balance carried down 3,500. 11th balance brought down 3,500. Next is wages account. Wages account, we have only one entry in the debit side, so then that is the total for both sides, 300, 300, (2008) January 10th, balance in date, balance carried down is 300, and next is the balance brought down 300. Wages account, sales account, only credit side, entries in the credit side, total 6,500, both sides 6,500. Then the total for both sides 6,500. (6,500) date 2008, January 10th, balance carried down 6,500, and on the 11th balance brought down 6,500. Sales account 6,500 balance. Creditor Hamamas 1,500. Both sides 1,500. Balance in date. January 10th. Balance carried down 1,500. Then here on the 11th, balance brought down 1,500. Date 2008, January 10th. Balance brought out, balance carried down. $3,000. Now the total, both sides 3,000. 3,000 here as well. Next, double line, double line. Drawings. Oh, before that we have to record the brought down balance. Balance brought down 3,000. Negos account and the drawings account. Drawings account 2008 January 10th. Balance carried down 500 total, and here on the 11th balance brought down 500. So now we have completed all the ledger accounts, and now using these ledger account balances, we can prepare a trial balance. Trial balance. Here the particulars or the account debit and credit, and now we can write the title correctly. This is the owner, the name of the business is ILA. Trial balance title, and the period it is as at 10th January 2008. So we have completed the title. put it nicely. Normally it is centered. Okay. This is the trial balance. Now look at each and every account, starting from cash at bank account. Yes, cash at bank account. Brought down balance is in the debit side, therefore it is a debit balance. Capital account, brought down balance in the credit side, therefore it is a credit balance. You know how to identify the credit balances and the debit balances. Motor vehicles, brought down balance is in the debit side, therefore it is a debit balance. Creditor lay motor traders, balance is in the credit side, brought down balance, therefore credit balance. Purchases, brought down balance in the debit side, therefore it is a debit balance. Wages expense, brought down balance in the debit side, therefore it is a debit balance. Sales account, brought down balance, credit, therefore it is a credit balance. Creditor Hamamas Limited, brought down balance in the credit side, therefore credit balance. Negos balance, brought down balance is in the debit side, therefore debit balance. Drawings account balance, brought down balance is in the debit side, therefore it is a debit balance. So now we can record them in the trial balance. Yes. Cash at bank account, 23,200 debit. Capital, ILA 25,000, and trade creditor Hamamas Limited, credit balance of 1,500. Next, motor vehicle, debit balance 3,000. Next creditor lay motor traders, amount is 500 credit. Next, purchases account shows a debit balance of 3,500, and wages expense, $300 debit. Sales credit 6,500, and trade debtor DEBTOR debtor, nego debit balance 3,000, and finally drawings account shows 500 kina debit balance. So now find the total. Total 25,000 plus 1,500 plus 500 plus 6,500 equals 33,500, and this side 23,200 plus 3,000 plus 3,500 plus 300 plus 3,000 plus 500. Then how much is the total? same amount, 33,500. So this is the total of the trial balance total, right? Trial balance total, both sides same balance. That means debit total equals the credit total. So this means we have recorded all the transactions following the double entry principles.